Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Agostino Pintus. Agostino is a former Inc. 500 technology chief and had a great success until one day he failed in spectacular fashion that kicked off his 10 dark years. He was ruthless with no direction and financially broke. It wasn't until a friend introduced him to the power of buying larger real estate deals that changed the entire course of his life. He ended up building a portfolio of over 1,600 units, a real estate development business, and a net lease fund. Today, he helped people to get into real estate deals of their own and build their own wealth. Welcome to the show today.
Thanks for inviting me. Greatly appreciate it.
Yes, awesome. So Agostino and I kind of know each other a little bit more. So I'll definitely dive into some really interesting story that he has. Let's kind of start it with, I can't help to ask you this question. How did you fail spectacularly? And then what does that whole 10-year dark years help you learn?
Sure.
Yeah.
So I think part of it is that I largely ignored my calling to be an entrepreneur, right? So when I was a kid and I was 10 years old, I was one of those kids that at 10, I was already writing code for, back then it would have been a Commodore computer, right? People don't even listening to this probably don't even know what that is, right? But it was Commodore computers or brand new computers brought into schools back then. So one of the first machines that the schools are actually using before Apple. Okay, this is how old this is, right? So
so you're running towards you're like the type of people who are running towards in new things and creating stuff for yourself. Yeah,
exactly. But I had visions of having my own computer company. I wanted to that was back then at 10 when I was writing code and really learning on my own how to do this stuff. Like the type of information that you had today in terms of the internet, in terms of all these access to information didn't really exist back then. It was all done. You go to a library, you get a book, you get a magazine, you kind of learn it on your own. And that really motivated me to eventually, I want to have my own thing. Right.
Yeah.
And the thing is, though, is that I got really, really good at the wrong thing, in my opinion, meaning that technology was my bag, and probably shouldn't have been. That's a whole other story. But what I ended up doing was going to, here I am, wanted to be an entrepreneur. My parents from Italy are telling me, you know what, you don't need to be an entrepreneur. That's high risk. You need to get a job is what you need to do. So they pushed me into getting a job as opposed to being an entrepreneur. I pushed on with school, a couple of master's degrees, undergrad engineering, all that fun stuff. And I'd go work at these companies. Part of it is my fault for not really working at the right companies. Some of these companies I worked at were really, really terrible companies, terrible people. They didn't really vet out. Probably should have done a better job managing my career. But other times, is just working in corporate America, it wasn't for me. It just wasn't for me.
Right.
And, where all you're doing is running a rat race. And there's many people out there right now. They do very similar things. They just do enough to stay in their crappy job. And that's what I was doing. I was one of those people. And eventually I'd say it's like I was here I am, Inc. 500 CIO. I rebuilt the entire infrastructure for this publicly traded company. I was still a young guy. I was in my 30s and changed the entire face of the company. Company decides, you know what, we're going to change direction and hand me the box, tell me to get lost. They did that with the entire management team. Right. We need to fresh blood, all this other horse crap that these companies come up with. And now what am I going to do? I had this giant mortgage, 2 cars, all these different things. I'm living to living the standard that most people should not be living. I was doing that just like many other people are doing today.
Right.
And you put a crippling divorce on top of all that stuff. Next thing you know, you're pretty much wiped out, and that's where I was. And for 10 years, I tried a variety of different things to try to really get on solid ground. Now, the one thing that I did do while I was working at that company was I started investing in single family homes. And even throughout these 10 years of hell that I went through, the one thing that no matter what was happening in my career life, trying to build a company or trying to work with other people, try to make money, was this small portfolio of single family homes is always kicking off some money, no matter what. And I'm like, so here I am, and about 10 years later, when I go talk to this friend of mine here about syndication, I'm like, you know what? this single family thing, I mean, no matter what, this single family, this real estate deal was throwing off money despite all this other problems that was going on in my life. I was always getting a check. Right. And I'm like, you know what? I'm going to do that. So I walked away from a 6-figure, big time C-level career to start all over again, to start at zero, basically. It was basically at zero, and and I'm condensing here because I know for sake of time, but I'll tell you that by using extreme focus on self-improvement, learning how to underwrite deals, learning how to network, getting in front of the right people, and demonstrating value to those around me is what really helped grow to what we have today. Now we manage well over $200 million worth of assets. This is all and I'm not talking, nothing wrong with being an LP. These are GP deals that I've put together with my partners, right? This is what I'm doing. It's not, so this is what I'm talking about. Which is a lot of work. Yes. It's a whole different scenario here, right? Not that I'm knocking the other stuff. But it's kind of like, but you learn a lot when you do all that stuff, right? You learn what not to do, what to do, how to put deals together. But now we do multifamily assets. We buy stabilized multifamily assets, A, Bs, mostly C stuff historically. We do development where we do either ground up development or historical developments. So one of the key projects we're doing right now is the Rockefeller building. It's John D. Rockefeller's old office in downtown Cleveland. It's where I'm at right now. And then the third aspect is the net lease property fund that we've recently launched, where that deal is we're just acquiring single tenant net lease assets to have corporate guarantee backing it up. So between these three things, we've been able to build a solid business that cash flows and is doing remarkably well. And I think back to my career as an IT executive, as much fun as it was early on anyway, before I failed, I would never do that ever again. I would never go back. I would never go back to corporate. No way, no how. I would never do it. I just love what I do now. And life is amazing now. So it's great.
That's awesome. And so I know that you are very experienced with new builds as well as multifamily. How did you decide to kind of I wouldn't say switch a career, but like expanding your portfolio into different type of assets, such as net leases and new builds, etc. And how does that tied in terms of our economy outlook, in your opinion?
Yeah. Sure. No, it's a great question. I mean, part of what we have to do as entrepreneurs is pivot your business. You have to be able to pivot, right? And look to see what's coming, look to see what's trending. And when I chose Cleveland and the Cleveland market to really invest in years ago, and when I say invest in, I'm saying to buy C-class multifamily stuff, older stuff, usually 100 units, somewhere in that range is what we were targeting back then. It made sense. Why? Because everybody had eyes elsewhere. Okay, everybody's buying the same sort of product, if you will, C-class, but they're paying like double of what it would cost here. So it's like you're able to buy stuff for $25,000 a door for a nice C-class asset, rents for $500, $550 a month, maybe even less than that. It's dirt cheap. But I knew that at the time, Cleveland was still well behind the recovery that the rest of the country had experienced. And I'm talking like about almost 5 years ago now, right? And I saw that. Meanwhile, as we've gone on since then, that same asset that we currently even own today is now more than double of what we paid for in terms of value. And the base
is very low. Yeah.
Exactly. So where cap rates are at now in terms of, where the market is, in terms of where the debt is, really the debt that we got on these properties is very similar to what we get today, actually, because we have really good relationships in place already. But I look and I'm like, I know I cannot justify the type of rent income versus the cost per door and the renovation and the cost to renovate. The time to renovate and the cost to renovate, especially today. So it's kind of like I can either take that renovation budget, if you will, throw it at an old 1960s build, or I can take that same renovation money and throw it at a brand new property.
Right.
What's going to get more rental output? Right. So as I look around and I look at development as an option, to help round out our portfolio. I'm like, the cost to doing this, I can get really good terms on debt. I'm building a nice property that's going to have very little in terms of, renovation. Obviously, it's going to be brand new.
Right.
It depends on the project, of course. And you don't have to really worry about upkeep because it's going to be brand new, right? There's not much in the way of upkeep.
Right.
It made sense, it made sense at the time. So we pivoted our business to include more development than acquisition of stabilized assets. And we just finished an acquisition I don't know, last month or something, or a month and a half ago.
Yeah.
And nowadays people are trying to now trade that same sort of asset for more than what we paid, like for that one on a cost per door basis. And the rents are about the same. And I'm like, I can't pay that. No, I just can't do it. It's, if I do, I fear that I'm not going to be able to get the return targets that we want to hit. So we just won't do it. That's the difference between how we do business versus some of the other guys. We don't collect acquisition fees, so we're not under pressure to like, hurry, we gotta buy this stuff right now. Either I buy it or I don't buy it. I don't care. I'm not going to get into a deal that I have to stress out about. I just won't do it.
Yeah.
That's how I'm able to continue scaling that side of the business. But right now, we're still opportunistic, but now the focus is more on development, and we're trying to be very careful about what we're doing on development now. So it's all. I would say it's all B plus A minus type of product that we're building. And the difference is like these it isn't like these things have these apartments or whatever that we're building have like pools and courtyards and all that stuff, but they have nice amenities. They're nice,
Yeah.
And they're shorter build times. They're about 12-month build outs. So we're trying to keep it somewhat tight in terms of the build time, so we can easily get it completed, get the lease up done, return money to the investors, and then cash flow it. Right. That's what we're trying to do in a very short amount of time. So just because I am concerned about the economic outlook in general. So I want to be able to get into a deal and turn it around as quickly as possible, or build it up as quickly as possible, So, and all of our projects are like that, with the exception of the Rockefeller. This is more of a 2-year project. It's a much larger project, but the plus side is that it's directly across the street, right behind me, actually, from Sherwin-Williams World Headquarters. It's going to be right next door to us. It's going to be like 6,000 jobs right next door.
Right.
We'll be fine. I'm not worried about it.
Right. Right. Exactly.
Yeah.
And it's iconic a building as well. And so why shortening of the time? And can you kind of walk through for our audience to overhear like the cycle of real estate development, and then why, like in the later cycle, you try to go for more like the new builds and more stabilized assets?
Sure. Well, something you just touched on it a second ago is the cycle, right? There's the Black Creek Group puts out this. It looks like a sine wave, right? It's like a chart, right? And it actually describes the cycle of inflation, hyperinflation, recession, recovery, all that fun stuff. And whenever there's a scenario like we're facing right now, Cleveland is probably one of the last markets to experience it. Other parts of the country have already experienced the cap rate compression around stabilized assets.
Yep.
And now I'm not the only one to do development. There's other guys that have done it too. However, the projects that we're taking on, like I said a second ago, like you alluded to, they're much smaller. And this is because back in leading up to 2008, these guys were buying or building rather these huge projects, 500 units, multi-year type developments, or multi-year type of single family home developments, right? Where there's like 5 phases of building up 200 houses at a time. I'm staying away from that kind of stuff because I am still somewhat concerned about the long-term of where we're going as a nation and where the economy is going, because you can't just pour trillions of dollars into the economy and expect no inflation to happen.
But which we already kind of see it now at the 7.5%.
Yes, that's right. So, and it's going to be hitting 8 here, I'd say, pretty soon. I mean, it wouldn't surprise me, next month, right? So, and that's the worst that this country's ever seen. And we still have 2 more years left of this president. So it's like, who knows what's going to happen in the next couple of years, right? Not that I'm getting political. I don't get political. I shouldn't get political, but it is what it is. I mean, you can't deny it, right?
I mean, there is an economist, scenario over here, like
Sure.
with the COVIDs and all that sort of stuff. And inflation is there. So these are facts. I don't consider that being political at all. And then I think the Fed's policy certainly does leads to certain things that happening and etc.
Yeah.
I think one part of what do you think inflation do to multifamily investing?
So the good thing about what inflation does to multifamily is that it's still putting your money into real estate. It's still a store of value, right?
Mhm.
Because if the asset is being run properly, you're still increasing your rents, you're still keeping up with inflation or beyond inflation, really. So it is a store of value, right?
Mhm.
That asset that you're investing in is increasing in value too, right?
But
And you're increasing the rents, works out great. If you're investing in some of the opportunity zone stuff that we're doing, for instance,
Mhm.
because that just happens to be the projects we're doing here in Cleveland, majority of
Mhm.
them are opportunity zone.
Yeah.
In that case, you're putting your money into an asset like this Rockefeller deal, for instance, and in 10 years, when the OZ matures, you pull all your cash out and the gains all tax free.
Right.
That's huge.
Right.
You're not going to get nailed on capital gains or anything else like that. You could pull it out sooner at 7 years, but I think it's some percentage less. I think like 20 or
Right.
30% less, or at 100% tax free at 10 years, right?
Mhm.
You can't beat that deal, right? There's nothing else on the planet that you can do that with. You can't
Right.
do that with Bitcoin. I'm not knocking Bitcoin. You can't do that with crypto. You can't do that with NFTs. You can't do that with any other
Right.
asset. You
Right.
can't do that with stocks. You can't do that with bonds. You can't do that with
Right.
real
In
estate's
fact,
the
if you
only
pull
thing.
out the money from the stocks, you could have potentially put in opportunities on funds and
Yeah,
actually offset some of the capital gain there too, which is a great vehicle.
yeah,
Yeah.
yeah. But it's still a fund though. Whenever you have a gain, you're still going to
Right.
pay gains on that, right?
Right.
So that's the thing. I mean, yeah, it's there's nothing else like real estate. That's why people in Congress they leave real estate alone because the majority of their wealth is tied up in real estate,
Uh-huh.
right? If you think about it, right?
Yeah.
Just do
Yeah.
what they do, right?
Yeah, exactly. And how did you guys expand it to like triple net leases or commercial? For folks who doesn't know, that is commercial spaces, commercial real estate spaces. Yeah.
Sure, sure. No, it's a great question. So like I said before, we have our stabilized asset, our development, and our net lease type of business. The net lease business is actually a fund. Okay, so what that means is we go off and raise capital, and it's a blind pool, and we do obviously what we're targeting to buy is the single tenant net lease type of assets. And what is that exactly? Think of Advanced Auto Parts, CVS, Walgreens, Burger King, McDonald's, Starbucks, your single tenant store that's in a great location or good location that has a corporate guarantee. These are all like usually publicly traded, they're AAA or B rated, companies that aren't going away anytime soon. The cool thing is that what we do is that we do monthly returns, right? And we're targeting 7 to 10% return, something like that, maybe more, but generally that's what the range is. And the thing is that we did that fund because there's sometimes deal flow between multifamily and the development side. There could be gaps, and
Yeah.
we know investors still want to invest with us. So we figured, hey, you know what? You put your money into this fund. Sure, the returns are not going to be as juicy as say a multifamily or a development deal,
Right.
but it's a risk adjusted return.
Right.
It's a very low risk. I mean, is Starbucks going out of business tomorrow? I would bet not. I would also say that to have a monthly return, if I can tell you that you're going to get a check in the mail or every month on the 5th, it's going to show up. I can tell you can bet on it. It'll be there. It's kind of like you have that versus multifamily where the stuff that we and anybody else buys, if there's a bad month, let's say for instance a bunch of boilers fail out of property, it's not covered by insurance, you got to fix it. What does that mean? That means nobody gets paid that month, or that means that it comes off the NOI because now we got to fix it, wasn't planned or whatever, right? So it's kind of like that, where with net lease it comes down to our ability to find a great property, have a good relationship with the vendor, with the tenant that's there, and of course having that lease that's locked in, know that return is going to be coming every month. That's huge. That's huge for those folks that are looking for that type of return.
Right.
So that's what we did.
It's kind of like a less return as a it's a lower risk, low returns. That's like the rewards and the risk. And then you have to kind of choose what your risk profile is as an investor as well.
Right. Yeah. But still, you know what though? You're still talking like 150%, 180% return. I mean, it isn't like it's terrible or anything else like that, but it's like, because I mean, it's syndicated in the same way we do everything else. Really, it's the same sort of structure. We don't take
cash flow.
So it's like we go in, we buy the asset, we buy a group of assets, not all at once. We buy the asset, we hang on to them for about, let's say, 5 to 8 years, maybe 10. But when we sell, we pull out the equity, give it back to the investors, and boom, there you go. You collected money all the way along, and then you got the equity back at the end. I mean, and you do it all over again. I mean, it's not a terrible deal, it's just different. I mean, there's but there are people that will talk to, and they'll say, well, yeah, but I can make more with multifamily. Yeah, if you could find a multifamily that makes sense, right? Sure, but like I said, I mean, I'm not getting into deals that we're buying stuff that like A class for very expensive, like $350,000-$400,000 a door, with rents are $1,500 a month. And we're not doing stuff like that. I just won't do it. It's ridiculous.
Yeah, exactly. That's awesome. Agostino, how can people kind of find you? I think this is a really insightful in terms of how the state of the economy is and what you're going through a cycle and what you should be investing in. How does people kind of find you and get to know more? Because I know you have a podcast, you host a lot of great guests, and there's knowledges and people can learn from you as well.
Sure. Bulletproofcashflow.com. That's how you find me. We have we put a lot of material out there. We're going to be putting more out there too here very, very soon. So I mean, come up, hit me up, set up a time, we'll go talk. Always happy to talk to people.
It's awesome. Well, thank you so much, Agostino, for your time today. And this wrapped up another episode of 10,000 Roads to Financial Independence. There's so many good nuggets from this episode, learning about the real estate cycles and also knowing where you're going to pivot your business to. I think that's very important as an entrepreneur. Cool. And then we're going to put all the context Agostino has in our show notes as well. All right. Talk to you soon.